It's Sunday, December 12th, 2021, here with this little bundle of joy, the new addition to the Babe family. You know, when you look at something like this is Kona, by the way. Say hi, everybody. Say hi, Kona. Say hi to everybody. When you look at this little creation, how can anybody say that there is no God, right? Right? You know, there's a lot of bad things out there. But when I look at little things like this, these little incredible creations, it just always makes me thank God that we're alive today and that we have little animals like this. And it's just so incredible. We are so blessed to be here, even though there is a lot of bad things taking place. But there's also a lot of good, ladies and gentlemen. And when I look at little creations like this, I thank God every day that I'm alive, that I have opportunity, you have opportunity. And sometimes we got to just take a break from all the negativity and the bad things that are out there. And we just got to really look at some of the good things out there. We got to take a break, enjoy nature, enjoy our cats, our dogs, whatever animal you have, your reptiles, whatever. And just really thank God that He's blessed us with so many beautiful creations on this earth. But again, when I look at little animals like this, could be a dog, a cat, a bird, a reptile, whatever, how can anybody say there is no God? I mean, it's just absolutely amazing. But little things like this bring me joy. They may not bring you joy, but they bring, all right, okay, take a break. All right, okay, go on. But they bring me joy. And I'm so thankful that we have her. So that is a new addition. I just wanted to let her say hello to everybody. But I want to get into this video because there is some real serious things that we do need to talk about. And we are going to be entering a new day in these markets tomorrow. I'm sure we'll see more magic tricks. But as you know and I know, more than likely the melt up will continue. The danger out there is going to continue. And I know, no doubt, believe that we're going to see a major banking crisis in America. I think a banking crisis is no doubt imminent here in America. You know, there's so many people that really have no idea. They believe that every cent that they have in their bank is FDIC insured. They believe that if anything bad happens, the FDIC will step in and they'll get their money back, so it can never disappear. But you know, you must realize that the FDIC insures a very, very minuscule amount of money in these banks. The FDIC insures $25 billion of deposited money in banks. There is roughly 11, 12, maybe even more trillions of dollars sitting in banks. So think about $25 billion insuring $12 trillion. That doesn't make me feel too comfortable. Now, you have a problem when banks are making very risky loans, as they did back in 2008. And we have banks today making very, very risky loans. Who knows what banks, your bank, could possibly be invested in Fantasia, Evergrande, a number of these development companies in China who are not going to pay these foreign bondholders back. And so if a bank gets into trouble, yes, the FDIC can jump in, but it can only insure $25 billion. If a big bank gets into trouble, it could get into trouble beyond $25 billion, beyond $50 billion. Then what happens? There's no guarantee that the government is going to borrow money, go to the FDIC, borrow money and say, hey, we need you to print this money. We need to borrow this. There's no guarantee that could happen. The government could go to other countries and try to borrow money, but who is going to want to lend? Who wants to lend to the United States of America right now? So it could be a very, very serious problem down the road because nobody wants to lend to the U.S. the FDIC literally could say we can't print any more money. So you're in big trouble. And so if your bank gets into trouble, now it either folds, goes belly up, or it does a bail-in and takes whatever depositor money is in those accounts just to stay afloat. And maybe your bank goes, hey, in order for us to stay alive, we're going to have to seize half of our depositor money. So you're going to have to make a sacrifice here so that this bank doesn't go under. So that'll be your patriotic duty to give us half your money. So be very, very cautious, ladies and gentlemen, where you're putting your money, who's holding your money, and how much you trust banks to be holding your money, especially right now. Look, ladies and gentlemen, I don't believe anything I'm being told right now, whether it's unemployment numbers, inflation numbers, how safe the banks are. Other regulators said the banks are safe, so we should all believe that. Everything is safe until it isn't. And we're going to come to a point where we're going to wake up one day and find out that, there's a hurricane out there that nobody told us about. Nobody's going to be prepared. Everybody relying on the system, everybody with their money in the bank. And I'm not telling you to take all your money out of the bank, but what I am saying is maybe you should have it spread around. Maybe you shouldn't have all of it in the bank. I think that's extremely dangerous right now. Just think what we've been told for years before the 2008 collapse, and then it happened and it came out of nowhere, right? We're being told right now that the economy is strong, the consumer is strong. Last year we needed more inflation. Now we have too much inflation. One minute they're telling us it's transitory. The next minute, now it's not transitory. So they're always behind. And by the time they tell you that we're in a recession, we'll already be in a depression. I was reading a really interesting article last night on The Hedge. It's titled, Friday's 7% increase in consumer prices is 11% when house prices are added. We don't use the old 1980s, 1982 formula to determine inflation any longer. If we did, it would be much higher. It would be around 15+% right now. In 1982, the CPI shelter component included house prices for owners' housing costs, but nowadays the shelter component for owners' housing is based on a non-market rent index. Home prices are up nearly 20% in the past year versus a 3.5% increase in owners' rent. Adjusting for today's shelter measure for the rise in home prices and removing the owner's index, today's inflation tops 11%. So they continue to manipulate things as much as they can. When there's 110 cargo ships out in Long Beach, what do? Well, they just push the ships farther out to sea so you can't see them. So it's not as bad. Look, these numbers, inflation, employment, unemployment, housing, everything is so manipulated right now, ladies and gentlemen. Household net worth hits record $145 trillion, up $34 trillion since the crisis. But there is a catch, ladies and gentlemen. It sounds like great news, isn't it? But the bulk of wealth goes to a very small fraction, and that fraction is the top 1% of the wealthiest people in America. Top 1% own a record 32.3% share of total U.S. net worth, or $47 trillion. So if you take that total, 145 trillion, 1% own $47 trillion of that amount. The richest Americans have never owned a greater share of U.S. household income than they do right now. And you can thank the Federal Reserve for that, ladies and gentlemen. The bottom 50% own just 2.3% of all net worth. That's $2.3 trillion. Isn't that amazing? The bottom 50% own 2.3 trillion dollars of net worth, while the top 1% own nearly $47 trillion of net worth. That's absolutely incredible. This wealth gap that we have continues to spread apart. Look, I believe that you should be able to make as much money as you want to. I believe there should be no limit on that. I respect people who are self-made, who have really, started from nothing and accomplished so much and made millions and billions of dollars. And I think that that's the American dream. It's incredible. But why does a small percentage of people get all the help from the Fed? Why is that money just pour into the very, very top of the pyramid and it doesn't trickle down to help anybody else? That to me is a very, very unfair game. And it allows people a large advantage over the rest of the population. And I think that that's completely unfair. It's cheating. The bottom 50% also own the debt. The wealth of the bottom 50% is virtually unchanged since 2006, while the net worth of the top 1% has risen by 132% from $17.8 trillion to $43.3 trillion. The economic recovery of easy monetary policy has helped to protect and grow wealth of the richest Americans. And this is appalling when I see the amount of homelessness. We have 14 plus million people in America that are food insecure. These food banks don't even have enough food to feed people now. And yet we have this very small elitist group at the very top getting all the breaks and getting wealthier and wealthier. The top 1% own assets. The bottom 50% own debt, ladies and gentlemen. Think about that. This is why I think debt is a killer. And we're going to see more and more people become debt slaves. People keep acquiring things with money they don't have, things that they really, really don't need. And I think that you need to think more like a central bank. You need to think more like the 1%. And really cut some things out in your life. Do you really need another big screen TV? Do you really need another car? Do you need 3 extra bedrooms at your house that do nothing to produce an income? There's things, do you need a $9 coffee every day? That's another thing. See, the problem is the majority of Americans can't cut things out. They can't stop spending. And you're not getting any help, ladies and gentlemen. You are not getting the advantages. These people are. These people can afford to go out and buy things. They can afford a $9 cup of coffee. They can afford $10 a gallon of gas. It's not going to change their life one bit. But if you don't start cutting things out right now, as this inflation is going to roar, you're going to be in very, very big trouble. And if you're a debt slave during this next depression, you're going to be in extreme trouble. You're going to be drowning in debt and nobody is going to come and save you. Household net worth up $34 trillion, but purchasing power is down 50%. Again, this inflation doesn't affect the multi-millionaires and billionaires. It is going to affect the average consumer making $20,000, $30,000, $40,000, $50,000, $60,000 a year. And remember, if you don't own it, it owns you. That is debt, ladies and gentlemen. If you don't own it, it owns you, whether that's a piece of jewelry that you financed, whether that's an automobile you financed, even your house. Look, you don't own any of it if you have to make a monthly bill, okay? If you don't own it, it owns you. And that means you're going to be working until it's paid off. And if you miss a payment, they're either coming to pick up your Rolex, they're going to come repo your car, or they're going to foreclose on your house. So this is why me personally, and I don't give financial advice, this channel isn't about financial advice. It's just me thinking out loud, sharing with you what I'm doing, what a lot of my friends are doing, and that is getting everything paid off and having zero debt. You are going to be less of a target if you don't have debt during this collapse. If you have debt, you're going to be in big trouble. They own you. They control you. Debt will control you. Debt will ruin your life. Debt will make sure that you don't sleep at nights. Debt will make sure that you are stressed out. Debt will get you sick. Debt will literally shorten your life, period. I'm going to tell you, when you have no debt or you have very minimal debt that is very manageable, you're going to sleep so much better at night. There is nothing positive about holding debt. When you're debt-free, you are no longer a debt slave. Another example of what's happening, just 50%, this is on CNBC, just 50% of college of the college class of 2020 had traditional full-time jobs 6 months after graduation. So here are people spending $50, $60, $80, $100,000 for a degree, and 50% of the class of 2020 had traditional full-time jobs, meaning the other 50% did not. So you better think about if that degree is worth it, if that career you're chasing is actually going to pay you down the road. Is it better to learn a trade and have a skill set or a degree? It's something you really have to think about, because these degrees, when you leave college, don't go away, and they accumulate interest. And there are people in their 40s, 50s, 60s, 70s paying on college debt. So make sure a career choice that you make is going to pay you at least enough to pay off your debt and to pay off that $80,000 degree that you've acquired. And it seems that more and more people going to college and getting degrees, these are going to be the slaves to the system. 30% of Americans have medical debt in America. Just think about what is going on here. The typical auto loan was 3 years. Now we're seeing 7, 8 years. And you know it's going to go to 9 and 10. 30% of Americans having medical debt. 50% of the college class 2020 had a traditional job. The other 50% didn't. The amount of credit card debt that people are carrying right now, mortgage debt, their rent. This is, again, I don't know how people are doing it. And every time I drive by a gas station and I see $5.15 super unleaded, $5.19 super unleaded, $5.49 super unleaded, about 2-3 miles from where I'm making this video, I don't get it. I don't get how people are doing it. I get how the 1% are doing it, but I don't get how the majority of this country is paying their bills. Now, I know that a lot of people pulled equity lines out, and people are now surviving off the equity lines of their homes, which they use as an ATM. People have pulled out personal loans. People are writing me saying that they're seeing more of these payday loan offices opening up. Let me know. Are you seeing those in your area? There's a few out here. I haven't seen any close, but people are saying that they're seeing more of these places opening up. I will say, as I drive through Southern California, I do see them quite literally everywhere now. Very, very dangerous. These are legal loan sharks. Danger, Will Robinson, beware. Never, ever go and take out a payday loan, ladies and gentlemen. They are literally putting you in chains and shackles at this point. 300-400+% interest on a loan. Give me a break. You're done. That is the worst thing you could ever do. So avoid getting into debt, number one. That's the best thing you could do, is avoid it. You know how they say, the best way to never become a drug addict is never do a drug. Well, the best way to never become a debt slave and to get into debt is never take on debt. Avoid it like it is a drug. Sailing away, super yacht industry booms. Again, this just reinforces everything I'm talking about today. The 1% are laughing all the way to their own banks. This super wealth that we're seeing is incredible. Private jet industry booming, exotic car industry booming, hypercars, super yachts. Now, the average consumer can't buy a pickup truck now, but if you're in the 1% and you need a 200, 300, 400, 500 foot yacht, you can get one. They're making those today. But if you need a pickup truck, you're going to have trouble finding one. Not a super yacht. You'll get a super yacht. I'm going to finish up with this last article coming from The Hedge, and it's titled, "We Expect a Sea Change. Morgan Stanley Admits It Was Wrong, Now Sees Liftoff in 2022 as Goldman Goes All In with 7 rate hikes." Goldman Sachs says that it expects to see 2 rate hikes in 2022, possibly 3. Morgan Stanley says no hikes. So somebody will definitely be wrong here. The Fed could be beginning rate hikes as early as March. Goldman Sachs thinks that it'll probably be around July, but possibly March. I think that if we have another month, maybe 2 months of inflation continuing to spike up, I don't see how they cannot begin to raise rates by March. In fact, in my opinion, they need to begin raising rates today. Honestly, it has to happen today. They're going to let this get out of control, ladies and gentlemen. And if they allow it to get any more out of control, we're going to see higher rate hikes, and more rate hikes. So I think we're going to see some very, very serious changes to these markets in 2022, especially the stock market and especially the housing market. So in my opinion, it's gold, it's cash, and it's patience at this point. The sales are coming, the hikes are coming, and the crashes are getting very, very close. We are going to see, I believe, and I'm not going to put a timeline on this. I don't have a crystal ball, but it is inevitable that a stock market crash is going to happen and a housing crash is going to happen. Bond market also. We're going to see serious crashes. Maybe it's not going to happen in 2022. Maybe it's 2023, 2024, 2025. I don't see right now how they're even keeping it limping along at this point. Things should have already crashed, but they have not. But in the meantime, the economy is crashing. And this stock market is on borrowed time. It is on life support. They have pumped so much medicine into it. And at some point, the medicine is no longer going to work. The US dollar is no longer going to work. They are destroying it, and they're destroying this economy while they continue to try and prop up the stock market. It's going to end, ladies and gentlemen, but in my opinion only, in my gut, I think 2022 is going to be a year that we're going to see some huge, huge problems in the stock market, bond market, and housing market. My opinion. We'll see how it plays out. But I think that the Fed is in a corner. I think they're in big trouble, and they're going to have to make some extreme moves here that are going to be very negatively affecting the stock market, bond market, and housing market. So we'll see how it plays out. Again, me personally, cash, gold, and patience. And we'll see how it plays out from there. Hope everybody's having a great weekend. God bless you all. Look forward to talking with all of you very, very soon. Make sure you subscribe, give this video a thumbs up, share this video. Talk to you soon.